I think that the market, investors are trying to figure out whether it is oversold at this point and ready to provide a nice entry point, at least in the short term. But I think that this market still has further to go. We broke below a very important support level at 4,300 on the S&P 500. And I think in the long run, we could end up testing the 3,800 level, which would put us just ever so slightly into bear market territory. It could end up just touching that minus 20% level, like we did back in 2018. We were almost down by 20%, and then the market rallied and ended up recovering quite a bit very quickly. Same with 2020. So it really depends on what is the driving force. If the Fed ends up saying that they are not going to be as aggressive as investors currently anticipate, if the Russians don't end up attempting to take over the entire country of Ukraine, we could find that there are several factors that would make investors breathe a sigh of relief. Because with oil prices continuing to rise, but also realizing that could end up putting a damper on U.S. GDP growth. Also now with a lot of commodities that traditionally come out of Russia and Ukraine possibly being in short supply, et cetera, the Fed, I think, is going to take a more measured approach. There have been 5 rate tightening cycles since 1990, and in each one of those 5, the Fed started with a 25 basis point increase. So I don't think that they're going to start with a 50 basis point hike this time. And rather than doing 7 hikes in 2022, our forecast is for 5 rate increases. Our 12-month target is still 5,024 for the S&P 500. So we still think that it'll be ever so slightly positive. So I guess you could say, like 1987, it was a very challenging year, but we still ended up being higher by 2% on a total return basis. I think the Fed is more important because it's interest rates that go into the intrinsic value calculation of stocks. And so as a result, I think that really is what is going to be driving stock prices in the long term. In the near term, sure, the uncertainty over Ukraine, how aggressive the Fed, how aggressive Russians will be, and also, what could happen in other parts of the globe that could be triggered by Russia deciding to invade Ukraine. So there are a lot of unanswered questions yet to be resolved. I think that for those who are brave of heart, they do want to start nibbling at some of those groups that really have been beaten up. Even though technology is down by more than 16%, you have several technology groups, such as application software, such as semiconductor equipment, that are down about 25% each. So investors might want to be looking to dollar cost average into technology. Or if you really sort of want to play it safe, what you can do is have an equal portion of technology offset by an equal proportion of consumer staples. This strategy since 1990 has delivered 96% of the return of technology, but with 40% lower volatility. I don't see oil prices remaining around $100 per barrel for the long term. I think this is a knee-jerk reaction to the uncertainty in Ukraine situation, as well as the expected reopening of the global economy now that the Omicron variant is subsiding. U.S. still is technically self-sufficient when it comes to energy needs, but we still export at this point as well. So I think that should we get additional output from the shale producers, maybe we even dip into the strategic oil reserve, I think that could help put a lid on energy prices. Plus, traditionally, the higher prices go, the greater the likelihood of demand destruction, meaning that people just don't drive as much, or they group trips so that they don't have to make individual trips. They lower the heat in their home, et cetera. So many times consumers will do things to help save energy, and that should bring prices down.